Welcome to today's class. Today is the first class on the topic capital budgeting. Now, what is capital budgeting? Capital budgeting techniques refer to analysis on which capital investment decisions are made. Broadly, there are two capital budgeting techniques. Number one, non-discounted cash flow techniques, and number two, discounted cash flow techniques. Number one, non-discounted cash flow techniques. The following are the analysis techniques under non-discounted cash flow methods. Under the non-discounted cash flow methods, we take into account those methods which do not take time value of money into consideration. The most prominent among those methods are payback period and accounting rate of return or average rate of return, in short ARR. There is also a payback reciprocal method and discounted payback method when discounting factors are integrated into the payback method, but it comes under discounted capital budgeting techniques. Now let's come to the payback period method. It is the most simple and widely used method. Payback period is the number of years required to recover the initial investment. So payback period is calculated as payback period equals to initial investment divided by annual cash flow. What is the acceptance criteria? We will accept the project if payback period is less than or equal to standard payback period. We will reject the proposal if payback period is more than the standard payback period. What are the advantages and disadvantages? First, the advantages. Payback period is easy to understand and compute. It focuses on liquidity, it uses cash flow information, and it is an easy way to cope with risk. What are the disadvantages? It ignores the time value of money. It ignores cash flow occurring after the payback period. It does not measure profitability. It does not focus on wealth maximization, and it is not an objective way to determine standard payback. Since there is no objective way to determine the standard payback, this is one of the most prominent disadvantages of the payback period method. So let us come to the example on payback period. If the periodical cash flow are equal, if the initial outlay of a project is rupees 5 lakh and if it yields an annual cash flow of rupees 25,000 for 8 years, then payback period equals to initial investment divided by annual cash flow equals to 5 lakh divided by 25,000 equals to 20 years. So the payback period is 20 years. Now let us come to an example where the periodical cash flow is unequal. Let us suppose if the initial outlay of the project is rupees 2 lakh and it generates cash flow of rupees 50,000, 70,000, 60,000 and 40,000 for the next 4 years, the payback period is calculated as follows. How is the payback period calculated? In this way. First, these are the period. In 0 year, the cash outflow is 2 lakh. The cash inflow in first year 50,000, second year 70,000, third year 60,000 and fourth year 40,000. Cumulative cash inflow, first year it is 50,000, next year 50 plus 70 equals to 1,20,000, and in the third year cumulative inflow is 1,20,000 plus 60,000 equals to 1,80,000. In the fourth year 1,80,000 plus 40,000 equals to 2,20,000. We see that cash outflow of rupees 2 lakh is recovered between third and fourth year. Rupees 1,80,000 is recovered within the third year and the balance of rupees 20,000 in the fourth year. We see here in the cumulative column that 1,80,000 is recovered within the third year. So the balance of rupees 20,000, that is 2 lakh minus 1,80,000, 20,000 is recovered within the fourth year. Assuming that cash flow occurs evenly, time period required to recover rupees 20,000 is 20,000 divided by 40,000 into 12 equals to 6 months. That is, the payback period is 3 years plus 6 months, that is 3 years 6 months or 3.5 years. So this is how we calculate payback period for unequal cash flow. With this, we come to the end of today's class. Hope you have understood what I have taught today. If you have any problem or if you have any questions regarding today's class, feel free to comment. I'll be happy to answer. Thank you for watching this video.